First of all, Scott, where are we in terms of overall debt levels? They at first came down much more quickly than people anticipated. Are they starting to grow again?
Yeah, well, thank you for having me. And yes, the answer is that gross debt, when we look at a company's balance sheet, just the sheer amount of debt that is on their liability side of the equation has been growing. It's actually picked up following the pandemic. You would, in many cases, anticipate that debt might fall when markets are in that much turmoil. But the recovery to both the economy and the market has been very quick. And something we have to keep in mind when we look at balance sheets is we have an investment management perspective, which we're talking about now, about debt levels and yields and spreads and what we're getting compensated for owning debt. But if we flip the switch and take a look at the corporate finance perspective, I heard in a previous segment you mentioned the S&P 500 is at an all-time high. So if we think about the debt to equity ratio that a lot of corporate America looks at, their equity valuations are very high,
right,
which is actually giving them an incentive to increase debt. So those ratios are actually indicating they have more debt capacity. So effectively, from their perspective, it's signaling a much different thing. I mean, you can take out a very high cost of capital and equity and move it to a lower cost of capital, which is debt.
I guess the question, though, is about stocks' performance for the next couple of years, obviously. So if we come back to this idea that the quicker they lower their debt levels, the fewer headwinds there are for their rebound, are we creating a drag? I mean, at some point, those debt costs have to be paid, right?
Yeah, the one thing about debt that I think a lot of people forget, whether you're looking at treasuries through corporate bonds, is that those maturity dates are payback dates. So what we encourage investors to do, and the way we're positioning things throughout our Core Plus and our corporate income strategies, is we take a look at a company and we see the gross debt has risen, but has it been offset by stable net debt? What net debt is telling you is how much liquidity or reserves are company holding against their liabilities. So if you're going to be using a higher amount of debt capital, that does leave you those debt to equity ratios and those leverage metrics. They do ebb and flow, and they're more subject to market volatility. But if you're holding a higher degree of liquidity, you're keeping your revolvers undrawn, and you have that backstop for your bondholders in check, then it's okay, and you can accept operating at a higher leverage profile.
Sure. So sort of fast forward the clock for us a little bit here. How do you think this all plays out? I mean, we've been speaking in the last few weeks about how yields on junk bonds were, approaching record lows. They were below the inflation rate for the first time ever. So any signs of uncertainty we'd be picking up in the space is not there. And like you said, that's kind of facilitating the increase in debt levels. Does this actually just support bullishness in the equity markets until it doesn't?
In reality, I think that when we look at valuations anywhere from corporate bonds through government yields through stocks, I think we all are holding our nose a bit at this point if we're putting more money into the marketplace. From the bond perspective and what the long-term implications are, is ever since the financial crisis where we saw mortgage-backed securities really get hammered and go through that high default cycle, there's been this sort of needling in the back of investors' minds that when is corporate debt going to have its super cycle? One thing that has changed dramatically, though, if we think about crisis response, is we've seen not just quantitative easing and low interest rate policy in the U.S. We've seen the Fed themselves backstop the credit and corporate bond markets, which means it's systemically important not just to expansions but to recoveries. So this could probably carry on for quite a while because we still think the U.S. economy has room in front of it for further growth and further recovery.
Shepard Smith here. Thanks for watching CNBC on YouTube.